The Federal Reserve is the central bank of the United States. It is responsible for conducting monetary policy, which means controlling the supply of money and interest rates in the economy. The Federal Reserve can influence the demand and supply of gold through its interest rate decisions and its balance sheet actions. One way that the Federal Reserve affects the gold prices is by influencing the inflation expectations of investors. Inflation is the general rise in the prices of goods and services over time. Gold is often seen as a hedge against inflation, because it tends to retain its value when the purchasing power of money declines. Therefore, when investors expect higher inflation in the future, they may buy more gold to protect their wealth, and this drives up the price of gold. Conversely, when investors expect lower inflation or deflation, they may sell gold and buy other assets that offer higher returns, and this drives down the price of gold. According to a report by the Federal Reserve Bank of Chicago, there is a positive correlation between the real price of gold and the long-term inflation expectation measured by PTR, which is a survey-based indicator provided by the Board of Governors of the Federal Reserve System. The report shows that from 1971 to around 2000, the real gold price and the long-term inflation expectation tend to move together. For example, a sharp uptick in inflation expectations during the period 1971 to 80 coincides with a dramatic run-up in gold prices. Gold prices fell dramatically during the Volcker disinflation of 1980 to 83, when the Federal Reserve raised interest rates to curb inflation. Over the period 1983 to 2000, the steady downward march of expected long-term inflation following the Volcker disinflation period coincides with the decrease in the real gold price. Another way that the Federal Reserve affects the gold prices is by influencing the real interest rates in the economy. Real interest rates are nominal interest rates adjusted for inflation. They represent the opportunity cost of holding gold, which does not pay any interest or dividends. Therefore, when real interest rates are high, investors may prefer to hold other assets that offer higher returns than gold, and this drives down the price of gold. Conversely, when real interest rates are low or negative, investors may prefer to hold gold as a store of value, and this drives up the price of gold. According to CNBC, gold prices extended gains on Wednesday as minutes from the U.S. Federal Reserve's November policy meeting showed a substantial majority of members opting to slow down rate hikes. The minutes indicated that the Fed may start tapering its bond buying program soon, but it may also delay raising interest rates until inflation is more firmly anchored at its 2% target. This implies that the Fed may keep real interest rates low for longer, which supports the demand for gold. A third way that the Federal Reserve affects the gold prices is by influencing the sentiment and confidence of investors about future macroeconomic conditions. Gold is often regarded as a safe haven asset, which means that investors buy it when they are uncertain or pessimistic about the outlook of the economy, financial markets, or geopolitical events. Therefore, when investors perceive more risks or threats to their wealth or well-being, they may buy more gold to seek protection and diversification, and this drives up the price of gold. Conversely, when investors perceive less risks or threats, they may sell gold and buy other assets that offer higher growth potential, and this drives down the price of gold. According to a report by The Sun, scientists in South Korea have managed to sustain a nuclear fusion reaction running at temperatures in excess of 100 million degrees C for 30 seconds for the first time. This breakthrough could pave the way for unlimited clean energy in the future. However, it could also pose a risk of nuclear proliferation or accidents if not handled properly. This could affect the demand and supply of gold as investors weigh the benefits and costs of this new technology. In summary, the Federal Reserve is the central bank of the United States that can affect the gold prices through its monetary policy actions and communications. The Fed can influence the inflation expectations, the real interest rates, and the sentiment and confidence of investors about future macroeconomic conditions, which in turn affect the demand and supply of gold in the market. In this section, we will analyze the recent Fed statements and actions and their impact on the market sentiment and inflation expectations. The Fed is the central bank of the United States, and it sets the monetary policy that affects the interest rates, money supply and credit conditions in the economy. The Fed's policy decisions can have a significant influence on the price of gold, which is often seen as a hedge against inflation, a store of value and a safe haven asset. One of the main drivers of gold prices is the inflation expectation, which is the anticipated rate of increase in the general level of prices over a certain period of time. When inflation or inflation expectation rises, investors tend to buy more gold to protect their purchasing power and hedge against currency depreciation. Conversely, when inflation or inflation expectation falls, investors tend to sell gold and seek higher returns elsewhere. According to the Chicago Fed letter, gold is a hedge against inflation, and its price tends to move together with the long-term inflation expectation measured by PTR, which is a survey-based indicator provided by the Board of Governors of the Federal Reserve System. The letter shows that from 1971 to around 2000, the real gold price and the long-term inflation expectation had a positive correlation. However, since 2000, this relationship has weakened and gold prices have been more sensitive to other factors such as real interest rates and macroeconomic conditions. Another important factor that affects gold prices is the real interest rate, which is the nominal interest rate adjusted for inflation. The real interest rate reflects the opportunity cost of holding gold, which does not pay any interest or dividends. When the real interest rate rises, investors tend to sell gold and invest in other assets that offer higher returns. When the real interest rate falls, investors tend to buy gold and avoid negative or low returns. The Fed's policy actions can influence the real interest rate by changing the nominal interest rate and/or affecting the inflation expectation. For example, when the Fed raises its policy rate or signals a hawkish stance, it can increase the nominal interest rate and/or lower the inflation expectation, leading to a higher real interest rate and lower gold prices. Conversely, when the Fed lowers its policy rate or signals a dovish stance, it can decrease the nominal interest rate and/or raise the inflation expectation, leading to a lower real interest rate and higher gold prices.